What's going on, everybody? Welcome to TrueBooks Tuesday, where we talk all things tax. A little bit different. I've got my partner Matt here, who's a licensed CPA. And in today's video, we're gonna be talking about something that I find really boring, but Matt probably enjoys it a lot. And I get asked it so much that I figure it's best to just make a video, get the professional in here. And that topic is, should I get an LLC? When do I get one? What kind should I get? How much does it cost? How do I get taxed? So we're gonna answer all those questions today, and let's just jump into it. Like, tell us, what exactly is the first step with getting an LLC?
Starting a business. Once you start a business and are ready to take it a little bit more official, I would set up an LLC. It's a limited liability company with your state where you're doing business.
All right, so I started a business. What's it gonna cost me?
So when you want to go out and set up an LLC, when you go to your respective state Secretary of State website, they're going to charge different fees to set up an LLC. Here in Nevada, it's $425, and then the renewal each year is $300. California, it's a little bit cheaper, but then you have an annual fee for about $800. So just know that each state is going to charge different fees to set up an LLC.
Okay, but why do I even need an LLC?
So most of the time that people set up an LLC is not really for tax reasons when most people think it is. It's really for legal reasons. But today we're going to touch more on the tax side. But when you're ready to set up an LLC, just know that it's when you're ready to take your business a little bit more official, maybe start opening bank accounts, getting loans under the business, things like that.
So when most people start, they're probably like a sole proprietor or even in a general partnership. That's bad.
Exactly. What I like to tell people with a sole proprietorship is like a lemonade stand. You're an official business, but you're operating as a sole proprietorship. It's you individually. There's no other business entity that is now doing business. It's just you.
Right, and I can tell you, Matt can't speak on the legal side for, licensing reasons, but I'll just tell you, because I'm not licensed, I can talk about whatever I want. Legally, having a sole proprietorship or even a general partnership is really bad, because now you're personally liable for everything. An LLC gives you a little more protection. Think about it like this. Matt and I are partners at TrueBooks, okay? If I go do something in my personal life that, gets me in trouble, Matt shouldn't be on the hook for that, okay? TrueBooks shouldn't be on the hook for that. That's just me personally. But if I was a sole proprietor and I did that, people could come after my business because they're one and the same, essentially. So always, always, always on the liability side, get an LLC. There's a whole bunch of other states and regulations that have different protections. Nevada has some of the best protections. You've probably heard many people say open one up in Nevada. Delaware's another one that has great protections because it's hard to what they call pierce the veil. And luckily I live in Nevada, so all of mine are Nevada LLCs, but we're not gonna talk a lot about the liability side, but just know that LLC is definitely gonna protect you a lot more than just running it, the way you are. Right. So they decide to start up an LLC. They've paid their $400, whatever. Now what?
Next, I would say go get an EIN. It's an employer identification number. So typically to how you personally have a social security number, you want to give your business some sort of identification number. When you go get a bank account, things like that.
So you can't open a bank account unless you go get an EIN. I've personally got the EINs before. It takes like 5 minutes. It's just irs.gov, right?
Mm-hmm. irs.gov, or just search EIN application and it'll take you 5 minutes.
Yeah, and they'll literally give you one like that. So
make sure you print out the letter that they give you because a good CPA will always ask for it. So a little pro tip.
Yeah, they'll also say, do you want us to mail you it? It'll take like 2 months.
Yeah, yes.
Or just give you it now.
Yes. Don't want to take it now.
Yeah, don't get it mailed. That's stupid.
Yes. And just know that you're going to need, when you go to set up a bank account, they're going to ask you for your LLC formation documents and your EIN number. So get ready for that.
Another thing that they'll need too is an operating agreement.
True. Most banks will actually ask for an operating agreement. Some won't, but he's right. I would get one in place.
And I know like in Nevada, they have like operating agreement templates that you can use. They're really basic. Like it's just putting how much of a percentage you own of the company.
What did you contribute to the company? Who owns what percentages? Things like that. It's very basic.
Yeah. So you don't need to like have anything crazy. You can actually do it for free. Personally, we get ours done professionally because, these are big businesses, but when you're first starting out, you don't need that. In fact, all of my businesses, probably my first 5 that I started, I just did them on my own. So now that they've opened a bank account, they've got their LLC, they've got the name. We didn't even touch on name, but if you ever want to know how to brand, we've done many videos on branding, so definitely go find them in, my different videos below. But now that they've got an official business, everything's on the up and up, why do they have that on the tax side? Like, what is the benefit?
So again, Most of the time when you set up an LLC, it's not going to be for tax purposes. But one thing you want to consider after you set up the LLC, after you get the EIN, after you set up the bank accounts, is you're going to want to declare a tax classification. That's where we have 4 options. There's 1, which is a disregarded entity. There's 2, which is a partnership. 3 is an S corporation, and 4 is a C corporation.
All right, so a lot of that is pretty foreign, even to me. Like, what is a disregarded LLC?
So a disregarded LLC is still an LLC, but for tax purposes, it's treated as disregarded, meaning it's not going to file a formal tax return. Most of the time for disregarded LLCs, you'll see people have rental properties in a disregarded LLC. So I can be John Smith and have an LLC that owns a rental property. Now that LLC will not file a separate tax return. All of the activity within the LLC is just going to flow through to me personally. So it's not a separate entity to the IRS for tax reasons.
So the way that I understand that is you're not really doing it for a tax reason. That's strictly liability. I don't want to own the rental in my personal name and then be liable if somebody gets hurt. I want to have an LLC, but I'm just still going to get taxed the same exact way.
Exactly. You want that 1 degree of separation legally.
So that makes sense on disregarded. When would I be treated as a partnership?
You would be treated as a partnership when, for example, you and a buddy want to go in on a deal or start a business together, and maybe you're 50-50, 25-75. You would set up a partnership for that. And now a partnership will file a separate tax return. This is what's considered, like you may have heard, a pass-through entity. All activity at the partnership level will flow through to the partners, and they'll pay tax personally.
All right, so let's say you and I are going in on a business and we're 50-50 partners and it makes $1 million net. Now, that would mean you made $500,000, I made $500,000, the business itself made $1 million, right? So on our tax returns, it's gonna show that I made $500,000, right?
Exactly. So the partnership tax return will show TrueBooks or whatever business made $1 million. And if we had $1 million in net profit, all of that is going to get distributed to the partners. The partnership itself will not pay tax. It's all going to flow through to the partners.
Right, based on whatever your partnership agreement is.
Exactly. And that's what's also nice to keep in mind with a partnership. When we touch on an S corporation later, you can't do this, is if you want to have special allocations, maybe one person's going to bring all the knowledge to the business and one person's going to bring all the money, you still can split capital evenly, you can split profit evenly, you can split losses evenly, or you can play with the percentages and do them different, 75-25, 80-20, whatever you want.
So with the partnership, is it only limited to 2 people?
No, so some of the other things you may have heard of are right, like real estate syndications, where you have maybe one general partner like Grant Cardone and all of these limited partners that have invested in this partnership. So there's all forms of partnerships with many different amounts of partners too.
Okay, so that makes sense. What about S-Corps?
S-Corps operate similar to a partnership, but like I mentioned with the special allocations of one person bringing money, one person bringing knowledge, everything with an S corporation has to be even. So you can only have 1 share of stock, they say, in an S corporation. So similar to a partnership, all of the profits are going to flow through to the partners or shareholders, but you can't do special allocations. But this is the entity that we like to use most for self-employed individuals. Maybe a real estate flipper, maybe a real estate agent, things like that.
Why? Why do we use them?
Number 1 reason is to cut down on self-employment tax. So back on the disregarded entity side or the partnership side, you're going to pay what's called self-employment tax, which is about 15%. If you're an S corporation, there's ways that we can limit that to where not all of your income is subject to that 15%, only a portion of it is.
Because essentially you're paying yourself a salary.
Exactly. So you are, if you're an S corporation, an employee of your own business. So now you'd be receiving a W-2 from your own business that you earn. So not only are you making money from the S corporation, you're making money as an employee as well.
So just to give an example to everyone, let's say I make $100,000 with my S-Corp and I pay myself a $50,000 salary. How does the self-employment play out?
So $100,000 through an S corporation. Let's say you made $100,000 as a sole proprietor back in the beginning of the video. You would be subject to 15% on all of that money. So that'd be $15,000 in self-employment tax. What Ryan just said, let's say you have an S corporation and you pay yourself a salary of $50,000. You're only going to pay 15% on that $50,000, which is $7,500. So just by having that tax strategy, you've cut that self-employment tax in half and saved $7,500.
So essentially you're just paying self-employment only on your salary.
Only on the portion that you pay yourself. But there's a lot of rules around what you pay yourself, so I wouldn't just go willy-nilly pulling a number out of thin air.
Right. So like let's just say I got $1 million business and I pay myself 200 grand, right? So I'm paying self-employment on the 200 grand, 15%, it's 30,000 bucks, right? But I am saving 15% on 800,000 now.
Exactly. So the rest of that is what we like to call a distribution. And so like Ryan mentioned, if you have a salary of $200,000, you're not going to pay 15% on all of it because there's a cap of about $130,000, but there's additional payroll tax you'll pay. But yes, you're on the right track. Is whatever you pay yourself in salary is what you're going to essentially pay self-employment tax on, and the difference is a distribution. All of it is subject to federal income tax, but it's that self-employment tax piece that we like to mitigate, because why pay more when you don't have to? Right. You could see how just having a different structure saved you $7,500 on only $100,000 of income.
Right. That's in for when you're making $100,000 to save $7,500. Huge. So let's talk about the last one, which is C Corps.
So C Corps is what you typically will see with like the Amazons, the Apples, large corporations like that. Most of the stocks you probably own are C corporations. Most of the time, we don't like to set clients up with C corporations unless they make a lot of cash and they're sitting on a lot of the cash. So C corporations have a flat tax. So back how we were talking about the pass-through entities, about how the income will flow through to the partners or the shareholders, the C corporation itself will pay its own tax. So on that tax return, they will have a tax bill. And right now, that's a flat tax of 21%, but Biden's talking about bumping that back up to 28%.
Got it. So they don't even have like the federal tax or anything. It's just purely you're paying 21%.
So you could see how if you were a high income earner making a couple million and you wanted to operate a business under a C Corp, because let's say your personal tax bracket, you're up in the 30s, well, you're like, well, hey, if I go set up a C Corp, I'm only going to pay 21%. But just know this is where you hear double taxation. If you want to get that money out of the C Corp and to you personally, you're going to pay a flat tax at the corporate level and tax when you take it out.
Really?
So there's that double taxation piece. So that's why most of the time we don't like to use them.
I was going to say, like, for me anyways, it may have made sense to do that. But if I'm getting double taxed, then no.
Exactly, because, right, so that's back to, if you're going to leave the money in the business or find ways to use the money within the business, we typically don't like to use those because there's that double taxation piece.
Got it. So for me anyways, I'm an S-Corp, correct? And the way that I have my LLC set up is pretty complex because I have so many different ones. But essentially each business I have has an LLC, and then I have a holding company LLC, which pretty much owns the businesses. And then I've got a trust and I've got all these other things for protection. But long story short, it's like all my businesses flow up into my holding company, where I then take a salary, where then I'm gonna get distributions as well. And that's kind of how I'm set up, right?
Yes, right. And so you can see how it's a perfect marriage between legal and tax. You want to make sure that everything is optimized and sort of flowing together, because if you just have something sitting off to the side, that may be hindering or increasing the amount of tax you have to pay. Whereas if you take a look at everything as a whole and everything comes together, that's where you're going to maximize the savings.
So that pretty much covers all the different LLC types. We realize that, hey, we don't want to be sole proprietors. We need to start an LLC, whichever type it is. To me, it sounds like an S-Corp is going to be good for the majority of people. Like, would you agree?
Yeah. So most self-employed clients are going to operate as an S-Corp. It lets you save on that self-employment tax. It gives you some of that legal protection. And overall, most of the time, it's the best entity and tax classification to operate out of. Because again, if somebody asks you, do you have an LLC or what are you taxed as? They're really wanting to know what your tax classification is. If somebody comes to you and asks if you have an S-Corp and you say, well, no, I have an LLC, they're most of the time one and the same. It's what's your tax classification? Right. Because, remember, an LLC can be 4 different things: a C Corp, a disregarded entity, a partnership, an S Corp. So it's tax classification that you really want to pay attention to.
Now, with all that being said, let's say you're a W-2 earner, right? And you're buying rental properties. In that case, you're probably going to just be a disregarded entity, right?
Exactly, because now you're just wanting to set up an LLC, give you some of that legal separation, throw the property in there. But again, a disregarded entity, you're not filing your own tax return. It's just going to flow through to you personally. So for tax reasons, you see it didn't help you at all. It's going to be the same. Right. But it gives you some of that legal separation where if you have a slip and fall, hopefully it will cause some of that separation where they're not coming after you.
Right. And I think the main key is that it's not really that difficult tax-wise. I mean, it's pretty simple. I'm not a tax expert, but I understand it. And hopefully you guys understand it as well. Definitely comment below if you understand what we're talking about, because it's not as crazy as people think. Really, at the end of the day, as we've kind of alluded to, many people just do it for the legal reasons, for the liability reasons, which makes sense. If I have $10 million in stocks in my portfolio, I don't want something that happens in my business to affect that. You know, if one of my guys on the sales floor screws up and, you know, we get sued or whatever, like, I need to be able to protect my personal assets.
Exactly.
So, anyways, guys, that's pretty much how you start an LLC, which one to pick, the fees, everything. Hope you guys enjoyed it. If you did, definitely comment below. If you haven't already, make sure you're subscribed to the channel. Make sure you give this video a like. Make sure you subscribe to Matt's channel as well, where it's just pure tax content. You guys know I'll talk about it because you guys want it, but I'd rather not talk about tax. He loves it, which is why I'm partnered with him. So anyways, we appreciate you guys for watching. Take care.